Welcome Making Money. This is Matt McCall. Thanks for joining me. Today's a special day. It's 2/22/22. All kinds of weird things going on with that. Good luck in my opinion. And we have a big briefing that we just put out here recently as well. A big emergency briefing talking about why markets are so opportunistic right now, why we cannot pass this up, why we have to ignore the headlines. Today's show, I'm going to talk all about the conflict going on in Ukraine and Russia. Not my political views or geopolitical views, but it's going to be about what sectors are affected, what stocks are affected, and if that's a concern to you, how to hedge against it. Also, could this be a great buying opportunity because most geopolitical concerns only last 21 days in the market. So all that and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It is February 22nd, 2022. If you wrote it out in numbers, 2-22-22. 2 is one of my favorite numbers. So this is hopefully a really good day for us. We'll see how everything turns out. Hopefully Russia heads back home, which I don't think that's going to happen anytime soon. But we want to talk a lot about that today. And we want to talk about the markets because the reaction that we're seeing, and I hope everybody, first of all, had a great long weekend, President's Day weekend. I was up in Palm Beach with a group of friends the entire weekend, so my voice might be a little hoarse this morning. But I hope everybody had a great, safe, fun weekend. Enjoyed some weather out there. Over the weekend, we had a lot of news coming out with Ukraine and Russia. Russia moving into two of what they call like the breakaway regions in eastern Ukraine. Luhansk, I'm going to butcher these names. And Donetsk, again, I'm 25% Ukrainian. My grandfather was from there, so I should know that better, but I do not know it. But so Putin came out over the weekend. He said that their government, obviously the Russian government, they recognize the independence of the two regions in the east, and that they're going to send their military personnel in to maintain peace. So that's maybe a way for them to get troops over there because they said they're maintaining peace. Apparently a lot of false flags saying that Ukraine's attacking them. That's why they're going in there. Who knows? There's a lot of unknowns. I think the big question mark right now is if they keep moving west and they try to attack the capital of Ukraine, which is Kiev, and that obviously be something that's going to escalate much more. If it just stays over here in the east, I don't think it will be as big of a weight on the market, on the global economy. Again, I'm not a geopolitical expert, just looking back in history and reading a lot of smart people over the weekend. That's what I gather from that. So that led to some big overnight selling. The Dow was down last night, Monday night, because we were closed yesterday markets. The Dow was down over 500 points when I was getting ready to go to bed. And now we can take a look at the markets right now. I'll pull up the Dow 30 for you, and we'll be able to see here. It's down about 221 points. Off the lows of the session, as you can see. And if we take a look at the SPYs, the S&P 500 ETF, we're down about 0.14%. Again, well off the lows, off the highs too. It's actually up a little bit earlier when I looked at the market this morning. And we take a look at the Qs, the more of the tech heavy, only down slightly, basically unchanged. It was up higher as well earlier today. So seeing a little bit of selling here. And if we take a look at the 10-year yield, which is obviously fixed income, it's around 1.95% here today. So people are actually selling bonds a little bit. I thought we'd see a bigger rush because overnight we saw this yield drop to about 1.87, I believe, as there was money rushing into fixed income. But you're seeing a switch of that. We had a bit of a panic selling overnight, a bit of a panic rush into fixed income, which pushed down the yields at that point. But we're kind of holding steady around 1.95. And I've talked about the yields. I don't want to get too much into this because I want to talk about the geopolitical conflicts here more today than anything. But again, I'd like to just look at this chart here of the 10-year yield and just show we're still down very, really, really low. Historically speaking, this is going back about 20 years where we stand right now below that 2% level. So again, at this point, not overly concerned about the 1.95%. Longer term, it's something that if it continues to move up, will have effects on mortgage rates and borrowing rates and other types of stuff, even getting car loans if you're going to buy a car. So it will affect that at some point, but right now, not my biggest concern. Back to basically Ukraine and Russia conflict. what I find fascinating is that if you look at geopolitical conflicts going back to 1950, including very, very big conflicts, geopolitical issues all around the world, not just anything just with the U.S., typically you see a pullback of about 21 days, about 3 weeks from top to bottom once that happens. And when that happens, a lot of times it freaks people out. But according to Deutsche Bank, they put out a report this weekend that the typical geopolitical sell-off is usually around 6 to 8% on average. And again, they kind of reaffirmed what I already knew, that it takes about 3 weeks for stock to bottom and then another 3 weeks for them to recover. So you're looking at about 6 week, month and a half cycle, if you will. And that's on average. It could be faster, it could be longer. But I don't see this turning into World War III, so I'm not too concerned with a bigger pullback here than outside of the average. The one kind of wild card is there's some weird things going on in the market now with inflation, near 40-year highs, interest rates going up. We still have a pandemic. Don't hear much about it anymore. You wouldn't even know it existed down here in Florida. We looked outside just because I was like seeing people not wearing masks anywhere. I can't tell you last time I wore a mask. So yeah, you will have other things pushing along. It's not just this conflict, but in the short term, this is definitely what's driving the markets and driving volatility, because we see as the news comes out, the market reacts instantaneously. So again, as we continue to see rumors and there's a lot of unknowns yet, we don't know how far Russia pushes into Ukraine, if at all, from here, and we don't know what the U.S. or its allies will do from here. There's so much up in the air. There was rumors that Biden and Putin were going to get together at some point. Obviously not in person, but to speak about the conflict. Let's see what happens. The U.S. government, which just drives me bananas, for like 10 days now, have been saying that this major attack's imminent. It's almost like a guy who's calling a bear market. Eventually, you're right. A broken clock's right twice a day. I hope they're wrong, but I don't want to see a major attack. But it's just like you keep spooking the markets and nothing's there wasn't a major attack yet, and they keep saying it's imminent. So it kind of drives me bananas that they're saying that. Keep that to yourselves, really. I don't think you need to be spooking out people more than you already have to. So what I want to talk about today, there are certain industries and sectors that will move both up and down based off conflicts. Some could be nice hedges for other things going on. And then we want to talk a little bit about some specific stocks in there as well. And, reading this weekend all about how this conflict could or could not affect the U.S. stock market, it's fascinating, because there is truly, at the end of the day, and this is not short term, this is longer term, folks, if corporate earnings continue to hit all-time highs, stocks will follow with all-time highs. And that goes the same for individual stocks. If they continue to make more money, then the price of that share, those shares will go higher. From month to month or even year to year, that could be out of whack. It's very irrational in the near term. And the thing is, with this conflict or potentially bigger political conflict, there's a low risk to U.S. earnings. And corporate profits will hit an all-time high this year, regardless of what happens over there, in my opinion. This isn't going to affect it at all. And I can't remember what firm it was that did a study. They looked at the Russell 1,000 largest companies here in the U.S. And the direct exposure to Russia via revenue generation is about 0.6%. So very, very small. Ukraine, 0.1%. And these are based on disclosed revenues that the companies disclose. So as you can see, that there's a very, very little exposure to anything that goes on over there. That being said, it could lead to some other issues. It could lead to slower global growth, for example. And if any economies have to shut down, if the conflict is much bigger in Eastern Europe, that could have an effect as well. You could see rising energy costs, and I'll talk about those in a minute. I'll show you some great charts, higher oil and that kind of stuff. You can also look at higher food prices. Again, I'll talk about that in a little bit more detail in a moment. And then when you combine all this with we already have inflation near 40-year highs, and the Fed's already planning on making moves in March and most likely the next few meetings to raise interest rates, that's what's spooking people more than anything. It's the combination of potentially higher energy prices, higher food prices with inflation already high, or with interest rates potentially continuing to move higher and the Fed continues to make moves. That is what's spooking people, I think. It's not just the issue in Ukraine. It's when you combine that with the other factors out there that are already moving the market, that's why you're seeing bigger moves than normal, I think, than you'd see in the short term. So please keep that in mind. But I want to show you, I want to pull up a couple of charts here in 1 second here, and just kind of give you an idea. And these are just some really cool charts I pulled from Statistica. And this talks about sanctions. You can see one here. And the sanctions, as you can see, it's the, why the U.S. has sanctioned Russia in the past. And it shows the appropriate or the approximate number of U.S. or Russian entities subject to U.S. sanctions for the following reasons. And you can see the 2014 invasion of Ukraine, 735, and you can see just different times they've gone after Russia. So if this happens again, it can have a material effect on the economy, which obviously is not good because this doesn't help the citizens, and then obviously they get angry at the government and some pushback. The next chart here, we get an energy cost. Now look at this. This is pretty amazing. This is the average energy prices in the U.S. and U.S. dollars. This goes back to April 2020 to January of this year. And you can see the rise here in 30 kilowatts of electricity, about 10% higher, which doesn't sound like a lot, but it's in a short time frame it is. And you know, the price gasoline per gallon, quite a big bump here, $1.55 higher, and it was only $1.95, so you can do the math. That's a big move higher. And then piped gas per therm, and you can see that's up about 35% or so from $1.04 to $1.41. And we're talking about more energy prices in a moment. And then we see here which European countries depend on Russian gas the most. And North Macedonia, Finland, believe it or not, it's right across from Estonia up north there. 94%, Bulgaria, Slovakia, Germany. But what I find fascinating is Germany, about, let's call it 50% or so, that's the largest economy in Europe. So it's not a small player. So that's one to keep in mind as well. That's where the ripple effect is. This could happen. And the last one, just want to show you where the pipelines linking Russia and Europe kind of come from. All these green are completed, and there's a couple under construction. So you can see, and this is Ukraine, folks. Look how many go through Ukraine. So if these get stopped down for any reason or shut, that could be an issue, and that could really weigh on energy prices at that time. So again, something that you want to keep an eye on. And Russia supplies about 40% of the EU's natural gas supplies via those pipelines I just showed you. Overnight, the Dutch gas futures, they were up. It's a European benchmark that they use for the gas futures, up as much as 13% overnight. The natural gas futures here in the U.S. were up about 6%. Russia also, though, is a player when it comes to oil too, not just natural gas. They have about 11% of the world's supply, about 10.5 million barrels per day. And that obviously sent up the price of crude oil because of what's going on as well, up to around $94.50 a barrel, which that $100 a barrel looks much more likely, believe it or not, if something keeps going on. So when it comes to the energy prices, that's something, again, that trickles down to most average people. And that's where you have to kind of be careful, where if that does, then suddenly our inflation numbers look even worse, because obviously energy is a big portion of the number. And you can look at the prices, the core prices, ex food and energy. But in reality, we pay for energy and food, so we should look at that. Even though they're volatile from month to month, it's something we should continue to look at. So Russia is a player. Ukraine's a player with that. And that's why you're seeing a lot of the energy stocks do well over the last few months, on top of other reasons. But I'm going to show you a chart here real quick. This is a Spider Energy ETF. You can see it opened at the high today around 70. Now we're down below 68 at the low of the day. From the high today to low today, again, we're only 45 minutes into trading here, but the reason for that is maybe people are seeing the conflict's not as bad. And again, we'll go back to the S&P 500 and what that's doing right now, and is down less than 0.1%. So they've come off the lows. And as I mentioned, it was down about 1.5% overnight. So well off the overnight lows. So again, maybe people are starting to say, maybe this is a buying opportunity. Maybe this is not the time to be panic selling. That's what I'm saying. I think right now is a great buying opportunity. Today we put out a webinar. I did an emergency briefing with our copy chief, Kelly. We sat down for about an hour, and I threw out tons of charts showing historically how this is a great buying opportunity, how the growth stocks right now are cheaper than they've been in so many years. A lot of these stocks could be at or near its lows that we'll ever see again. So I put together a portfolio of 10 stocks that are released called the Inevitable Portfolio. And I'm so happy to do it. And as you know, I don't buy or sell any, invest in any stocks that I recommend. We have there's a wall there for many reasons. So what I did today is I got my own basket of stocks. Outside of that, I bought some because I truly believe right now, today is a great buying opportunity. Do I know if today's the bottom of the pullback of growth stocks or the market? I have no idea. But I do know that I'm a long-term investor, and even looking out a couple of years, and normally I look at least 5, if not more years, 5 to 10. But even looking out a year or two from now, I believe the market's going to be much higher, especially the stocks that in my watch list, these growth and innovation-oriented stocks. And a portfolio put together is very diverse. Some companies, they're about 1 billion, some are up to almost 10 billion. So in small mid caps, but all growth. Every company has projected growth on top and bottom line in the next couple of years of at least 20%. So you're investing in growth. And eventually, as I always say, growth will pan out. If you make more money, your stock price will go up. And a lot of these companies that I've recommended on a watch list right now, what's amazing to me is during the pandemic, the last couple of years, revenues continued to grow every single year. Yet a lot of stock prices are down 50%. And keep in mind, just to get back to where they were, that's a 100% move. If you fall from 100 to 50, you get from 50 to 100, you're doubling your money. Such opportunity out there right now, folks. It's really, it's tough. I know people think I'm crazy sometimes when I say this because I'm so bullish. But again, I read, I interview, I travel. I was with a group of people this weekend, some of the most influential people you know, and from all walks of life, a movie star to one of the most influential political people, a radio host that has more listeners than most people you could imagine, and all talking, and they all don't have financial backgrounds, but people who are on the ground, they travel the world, they're all over the place. They see this, they talk to people, and this is how I do my research. I sit there and I just listen. And it's amazing how when they listen to me about innovation and growth going forward, how their eyes pop up. These are smart people and they get it. But sometimes you have to keep saying it over and over and over. And the companies that will benefit from that are the companies that we're investing in. Again, pullbacks from time to time happen. I talk about this all the time. Corrections since 1950 happen on average once a year, and a correction is a pullback of at least 10%. It's normal, and usually at average pullbacks around 13 to 15%. That's normal. This is not crazy. And it's driven by different things every time. This is driven by higher inflation, higher interest rates, a pandemic, and geopolitical concerns in Russia and Ukraine. It's always going to be different. I mean, it may be inflation again at some point down the road, or interest rates at some point down the road. But typically, it's going to be a little different every time. But it's not different because we're emotional human beings. We react the exact same way every single time. We panic, and then we're chasing our tails trying to get back in. The smart long-term investors, I shouldn't say smart, the successful long-term investors use that panic and go the opposite way. It's the wolf and the sheep. The sheep, you know how it ends for them. Wolf, they eat very well, and they end up on top. So again, look at this as an opportunity. I'm not saying you go out and put every dollar into the market you have today, but I do think there is great opportunity out there right now. And you would think Bitcoin would be doing well in this type of situation, but it's not, because we're having that risk-off trade away from what people perceive as risky assets. Bitcoin's still perceived as a risky asset, so you're seeing selling over the weekend in Bitcoin. I stopped checking my Bitcoin over the weekend because I was at this cookout for a few days, and I didn't want to look at it and ruin my day. But again, I'm fine. And it's funny, a lot of people there are big into Bitcoin too, and it's just amazing how as you become more of a successful investor, you realize you don't care about the day-to-day or month-to-month swings. If anything, you buy more on pullbacks. So that's really how I see this affecting it. Let's take a look at some stocks too. There's a bunch of firms putting out different stocks that they feel could benefit from a continued conflict over there. Again, though, this conflict hopefully ends soon, so it may not be the best angle. For me, if I'm looking at a stock that could be a hedge against the conflict, I also want to like that stock long term, not just in the conflict. And that's where a lot of people make mistakes, is they look just for stocks to hedge. But the problem is, as I just mentioned, the average pullback's three weeks and the average gain is 3 weeks. If you don't time that right, you can actually lose money in there. You could hedge for a minute, but then that hedge doesn't work anymore and it pulls back. So you have to be very careful. There's one stock that I've been watching and one of the firms mentioned, and this is Nutrien, symbol NTR. It's about a $42 billion company. It was created in 2018 when potash and agrium they merged, and it's the world's largest fertilizer company by capacity. So I'll bring up the chart here for you in a second and give you a look at it. But you can see in this chart once it pops up, look at this great. I mean, this has been doing well even prior to the conflict. And if I zoom out a little bit further, you'll be able to see there that's just off an all-time high. And it struggled. What a pullback and buying opportunity down there on the pandemic sell-off, but again, hit an all-time high on Thursday and pulling back a little bit. So I like this. This is a play where, again, if conflict happens, it should actually do well, because if the prices go up, potash and all these other agricultural chemicals that are needed for growing grains are great secondary plays on that. So that's one you may want to throw on a watch list. And keep in mind, nothing here is a buy or sell recommendation. I just putting out ideas, trying to educate you, and you do your own due diligence, make your own decisions. And I said, when I say add to your watch list, is you watch it. It's not saying around buying it. I would add it to your watch list. Trying to see what else out there in this area. Mosaic's another one, symbol MOS. And Mosaic's going to fall in a very similar industry as Nutrien. That was formed back in 2004, so it was formed a long time ago. It was Cargill. I remember Cargill. Their fertilizer business was merged with IMC Global. And it's about a $16.5 billion company. It's a leading producer of crop nutrients, phosphate, and potash. And again, when I show you the chart here of Mosaic, which is symbol MOS, you will notice just how nice these charts look. Again, hitting a high, pulling back, consolidating, but it has been doing well prior to the conflict. So it's not just a conflict play. And that's what I'm looking for here, and why I find that important. There are, there's energy stocks. I talked about those a week or two ago, so I'm not going to jump into the to energy stocks. Another area to look is, I hate to say it, but the aerospace defense, the Lockheed Martins of the world, the Raytheons of the world, Raytheon Technologies, RTX. Pull up a chart here for you, as you can see. Look at this. This is, again, done well during everything that's going on prior. This is obviously the pullback from the pandemic. You take that out and things look good. Trading just off an all-time high that hit about 2 weeks ago. So again, like these stocks have been doing well, continue to do well. We take a look at Lockheed Martin, symbol LMT. Again, not too far off a high here. It's up around 440. So these stocks obviously do well during conflict because they make the weapons and the planes and etc. So they obviously have higher demand during times of heightened geopolitical conflict. So again, I'm not saying run out and you buy these, but again, just showing you there are certain areas. So a lot of it's going to have to do with grains and nutrients and agricultural chemicals. Energy, again, I talked about that already. Some of the aerospace defense. Those are the areas I think you really want to look. And if you want to look also at, I mentioned aluminum, that was near a high. You can look at some of the aluminum stocks and see how they're doing. Let's take a look here. This is Alcoa, symbol AA. This used to be a much bigger name in the market. People used to follow it. But Alcoa, years ago, when I first got in this business, it was really the first company to report earnings in earnings season. So that was kind of the bellwether. Now people don't even talk about it at all. But again, look at this chart, folks. Alcoa was around $10 back in late 2020. Now it's at 75. And if you zoom out here and just take a look at this chart, I mean, my goodness, look at it. I was single digits after the pandemic, and then we hit close to $80. We're at 75 now. But ways to kind of hedge. And I would look to, if you want to have exposure to metals, I personally prefer the industrial metals such as aluminum, such as nickel, such as zinc, versus gold. If I had to pick gold or silver, I think you know the answer to that. I would always lean towards silver. Another area that Russia has some exposure to as well, palladium and platinum. Those are areas, two metals that again I like better than gold, to be honest with you. And I think you'd want to look at palladium and platinum over anywhere else at this point. So yeah, so that's kind of my breakdown of kind of where we are with that. I'm just going to pull up one more chart here and show you the S&P 500. We're basically unchanged. So we're up 0.1 on it, 0.02%. all things being said, where we were last night, down 500 points. At one point, the Nasdaq futures were down about 2.5%, which is it's a pretty big move in one day. And now we have the Nasdaq right here, the Qs, up 0.36%, so up about 1/3%, and they were down 2.5%. A big turnaround from overnight to tonight. So maybe we've seen that capitulation overnight. Markets weren't open here, but they're open overseas. Again, we have a webinar emergency briefing that I put together. It's very raw. We literally sat down, got out a bunch of charts, and looked at it. And you could take a look at that. We'll put a link in there for you if you're interested. Just released the Inevitable Portfolio, 10 brand new stocks, never recommended before. It ranges from a sports gambling company, which I think is a huge industry going forward. We have some tech companies in there. We have some transportation EV related companies. I mean, we actually have a metals company in there, so diversifying that angle as well. And it's what I love about this is you buy the whole portfolio. You don't cherry pick. So if you have 10,000 hours, you put 1,000 in each, and you let it go, and that's how you measure. You're basically creating your own innovation, inevitable portfolio of 10 stocks, and that's your ETF. You let that go. So I'm super excited for that. I hope everybody enjoyed the video if you had a chance to watch it. But again, thank you so much for watching this. We'll be back on Thursday. Hopefully markets are much higher. Hopefully the conflict's less. But if anybody's over there in that area, please stay safe. Again, my 25% of my heritage is from Ukraine. I have a lot of friends from Ukraine. So I hope everything continues to be safe and everybody, it all works out. But thank you so much for watching. I hope you have a wonderful Tuesday. It's 2-2-2-2-2. I love it. All right. We'll talk to you Thursday. Thank you so much. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.